You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome to the show, Tim.
Jim, thanks again for having me.
Last time we chatted, we discussed that people now are being forced into the equity markets. Pensioners, if they want to see any return on their money, are being forced into the equity markets. A risky place to be at the best of times, and this may not be the best of times to be getting into equities.
That's exactly right. I have an article I'm going to get to you in the next couple of days, maybe this evening, talking about the deflationary outcome. And, kind of a long way into addressing what you just said there, is that, if you stand back and you just look at things with common sense and kind of look at the forest instead of the trees, it's pretty obvious that the deflationary forces with the economy, and globally, really, started in, bearing down in 2000. And that is what the powers that be, the money managers, the money masters have been fighting since 2000. I mean, that's why we have seen, the liquidity campaign to reinflate is because of the deflation. And in the process, they created the commodity bubble and the housing bubble and, somewhat of a stock market bubble in 2000 into the 2007 top. And then, of course, it all imploded. We had the banking crisis and the worst financial disaster since the Great Depression. And then, coming out of that bottom, what do? Well, more of the same. And so, people can't go to bonds because interest rates are so low and get any kind of return. There's really no place for people to go. And so where we were going with this is force them into a market, into equities for a return. And the thing is that it's a mirage. That's the danger of this, is that it is a mirage. And when I say mirage, I mean, yeah, it's there, but it's not there. It's not, it's there in the sense that, yes, prices have been pushed into, I think this time it's all resulted in an equity bubble. The commodities failed. Housing, yes, they bounced, they recovered some, but I think, looking at the housing indexes, they've probably, if they haven't peaked, we should be close. They're showing signs of trouble. Commodities rolled over in 2011, and people don't realize that, but they did. Looking at the CRB index, and then in 2013 we had kind of the final nail in the coffin. 2014 we saw oil prices and everything really come apart, and so it was, the setup there was kind of slow and subtle, but it happened. And so what I'm saying is everything coming out of the 08, 09 low has been bounces, and within the context of that secular bear market, and only equities have been pushed to a new high, and it has forced people into that market. But the danger is that they're going to be killed here. They're going to be crushed. And I've said that because of the extension of this rally and the context in which it has occurred, being a secular bear market, nobody can get their mind around that, because they think that because prices at a new high, it can't be a bear market. Bull markets are not born solely on price. And we've talked about that. But anyway, the point is that it's forced people into this mirage market, if you will. And, I think they're going to lose all. I think this is going to be, an even worse financial disaster than what we saw in 2007, because people have been forced into the market. It's going to come apart in a deflationary outcome.
Earlier this week, some of the tech darlings seem to have lost a lot of value. Apple, Twitter, LinkedIn.
Yeah, I mean, it's cracks. And when you look at, last night I spent some time looking at some of the foreign indexes, the CAC, the DAX, the FTSE, and some of those indexes, they're showing signs of trouble. Is the die cast on it yet? No, I'm not saying that, but we're seeing major issues, and that's, I'm monitoring Not all the DNA markers with the I's are dotted and T's are crossed, but I tell you what, I wouldn't want to be in the equity market or have exposure to it at this point. And, once, like I said, once it's amazing. It's a hard concept to grasp, but the markets are all about structure. And when the structure is in place, that the structure is positive, the market's going to shrug off bad news, or there's not going to be any bad news. It's kind of like the structure sets the tone and things are good. But then when that turns and the structure is set up and the die is cast with negative structure, I promise you, bad things are going to happen. The skeleton's going to come out of the closet, be it a banking crisis, a housing bubble, a subprime issue, or, I don't know what it's going to be this time. But something's out there. When it sets up, it's coming. It will happen. And the statistics will be fulfilled, just like they always are.
Did quantitative easing set people up for this big fall?
Yes. Yes, it did. And that's one aspect of what I've said before. They have tried to, what they have done, it's real simple. If you look at the job participation rate, if you look at the volume, characteristics of the market, if you look at the velocity of money, if you tie all that, so you don't really have to look any further than that. I mean, how can you have a recovering economy when the velocity of money has just collapsed? How can you have a recovering economy when the real job, when there is no job growth? I mean, I know they throw numbers out there but that's all, pardon my frankness, it's all BS. When you look at the hard data, per the Fed, I mean, that data is available from them. When you look at the hard data, the job participation rate, which to me is more meaningful because that tells you how many people are actually working of the percentage of people that are available to work. Okay, you created 200,000 new jobs, but you still have overall the job participation rate is at levels not seen since 1977 when you had 100 million less people. So let's put those statistics into perspective where they have a real meaning and quit playing the shell game. It has collapsed. And so I don't care who tries to tell you that you have a recovering economy in those conditions. They're either a fool or they're lying to you. And it's that simple. You don't have to be an economist. It's real simple. And so what I'm saying is what they have done is I understand it's a real simple concept. What they have done with all of this liquidity infusion is they tried to jumpstart. It's ether in the carburetor to try to jumpstart the economy, to try to get things rolling again, and then hopefully once it got rolling, the jobs would come around. And if the economy came around, the velocity of money come around, and things would pick up, and everything would be okay. But the problem is that they have inflated and inflated and inflated, and they've done this and they've done this, and they force people into money. Into the market. There's no place for a return, and the economy hasn't picked up. It's gotten worse. And so here you are in this act of levitation in in a bubble. And I don't know if it's going to last. Like I said, it's the setup, it's the structure. And every setup or the structure with every setup is a little bit different. And let me back up a little bit and explain that. In 2000, we had the setup with the DNA markers in January of 2000 on the industrials. They set up, and then the market just kind of hung out. The setup stayed in place, and the market just kind of, if you go look at a chart, it really didn't do anything. It just kind of, levitated. But the setup was there, and it took a while, and I think the S&P, as I recall, made its high in March. And then it wasn't really until 2001 when things came apart and got ugly. And so that setup took a while. I mean, once it was in place, it took a while for the market to really roll over and the rest of the statistics pertaining to that setup to be fulfilled. In 2007, we got the setup in October. Wham, bam, boom, done. Down it went. And so you never know exactly how fast something, once the setup is in place, how fast the decline is going to be. But once it's in place, it's done. The die is cast. And so what I'm saying is we've been seeing setups trying to occur since about this time last year, trying, and it kind of, it would never materialize and be blown out, and try again and it would get blown out. And so the structure, it just never really stuck. And I don't know if we're going to play that, let's kick the can down the road another month, another 6 months, but once the setup is in place, I'm telling you, the downside risk to this market is absolutely insane. I think it's going to come apart, and I think this time it may well come apart sooner rather than later. When I say that the rate of descent, because of the statistics, the underlying statistics that should be fulfilled, and because of the duration in which it's kind of like blowing up a balloon. You know, the louder the tighter, more air you put in the balloon, and higher, you know, the tighter it gets, the louder the bang when it pops, that kind of thing. And so, I maintain that this is the most dangerous stock market environment since the inception of the averages. And I say that for a number of reasons. Because of the extension, because of the fact that it's has occurred within the secular bear market, because of the fact that the Fed has done what they've done to try to reinflate, and it has failed. And I say failed because it hasn't jump-started the economy. Yes, it's created a bubble with the stock market, and because it has forced people into the market for a return, it has convinced people that this advance is real in the sense that it's sustainable, and it's not. And when they lose this time, they lose big, and I think it's more global this time. So I think that it's just one hell of a mess once it sets up and starts to come apart.
We'll have more with Tim Wood right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, is one of the problems that CEO pay is based on share prices instead of how many new jobs or factories the company has opened?
Not from my seat. I think that's just another, phenomena of this time of the, or how do I want to say that? Another indication of the times, if you will. I mean, the share price is a game in and of itself. The earnings per share, there's a big movement with buying back the stock, and the less stock is there, then it inflates the earnings per share and makes the company look good when really the earnings aren't there because the economy sucks. And so it's all a game. It's all a mirage. It's just another piece of the environment in which we operate. But is that directly attribute to the fact that this is a bear market rally? No, technically it has nothing to do with it. I just think it's a sign of the times, and another game that's being played with numbers.
People in the oil industry seem to be very bullish, the price of the barrels of oil going up, but again, is that setting people up for a terrible fall?
Yes, I think so. We correctly identified that within the next day of the bottom with this intermediate term advance. And, I think we've said it on the show, there's a multi-month rally going on with commodities, and that multi-month rally is still underway. And not only that, but, the cycles were right on time. There is a tendency, a seasonality, to have lows in late winter, early spring type time frame, and then you rally into the driving season. And so that and the cycles coincided perfectly, and we got the rally in oil. But I think that it's just that. I think it's a counter trend move. And then, because the downside objectives have not been fulfilled on oil, there are some statistical relationships that should go back to par. And they haven't. So I think that there's more downside with commodities once the rally is over. And, when will it be over? Well, it'll be over when we get that set up to cap it again, with the proper structure, with the DNA markers, left translations, failed cycles, and that sort of thing, that will tell us that it's done.
What about gold? If the equity markets start to go down, isn't gold the traditional hedge?
No, I think that depends on the cycle. And, in 2000, people thought that in 2007, and look what happened with gold. I mean, gold got hammered in 2008 and into the 2009 low. And, I think that everything is going to go down together this time as well. The 9-year cycle is on a downswing. Gold has been trying to rally out of intermediate term lows, just like, the rest of the commodity complex. And I realize people say, well, gold's not money. Gold's not a commodity. It's really money. I get that, but it's moving with commodities nonetheless. And so, I see it in a counter trend bounce that's going to go down. I think everything is going down together, just like before.
Tim, of course, we always say that's pretty sad news for so many people. Is cash your only refuge right now?
I wouldn't want any exposure to the market, because I think it's vulnerable. Like I said, I don't think that it's not completely set up yet, but yeah, what's wrong with being in cash and being on the side? Okay, you don't get a return, but, do you want, here's what's going to happen to people. Here's the danger. and they don't get out. They're in the market. They're not listening to the warnings. They say, yeah, you've been saying this forever. What I've been saying is that it's going to continue until we get to setup. When we get to setup, it's coming unwound. And the statistics tell me it's going to be bad. But they're not hearing the message, or they don't believe the message. People believe what they want to believe. Don't confuse people with the facts, and that's just human nature. I'm not trying to make anybody mad. It's a fact. It's just human nature. And so what's going to happen is it's going to set up. We're going to get a decline, and people aren't going to understand what's happening, and then it's going to come unraveled, and they're going to say, well, if it's going to bounce, it's going to bounce, and then I'm going to get out, and it's going to bounce, and I'm going to get out, and it's going to come apart so hard and so fast that they're not going to get the opportunity to get out, and they're going to be left with massive losses, and that's again another reason why I'm saying that it's so dangerous. The market is so dangerous, and it's going to take people's money. Richard Russell once said the ones that win in the bear market is the ones that lose the least. And this is how the bear takes money from everybody. They've been given a gift to have a rally like this within the context of a bear market. And anyone that's still in this thing, they are going to be crushed.
I've absolutely heard that before, too. The real secret to success is not losing your money when everybody else is losing theirs.
Right. And I understand this is an extreme message that people don't understand. I get it. But if you don't understand it, and if you want some hard facts, I put this stuff in a research letter. And it's just data. If people, they want to know more, they can look at it in the research letter. And it's not opinion. It's just fact. It's just fact. And you can't argue with the facts. And I don't play games with statistics and numbers. it is what it is. And, I'm telling you, this is, we're setting up, or I say setting up, I guess literally we are. We're in the process of setting up, I should say, for, one heck of a top.
Well, Tim, too, people are relying on automated computer programs to save their butts if there's a drop, but they keep forgetting that if there's a massive drop in the market, they have a stop. The market closes, and you're stuck holding on to that stuff that by tomorrow when it reopens is going to be worth a whole lot less than it was when it was stopped.
Exactly.
So how can you save yourself?
Well, under those conditions you can. The only way knowledge is power. It's like in the movie Wall Street. And I don't remember the exact quote, but Gord Gekko tells Bud Fox, he says, something to the effect, he said, wouldn't you agree that the most useful commodity or something like that is information? In other words, understanding data. And if you don't understand the environment in which you operate, then how can you successfully operate in that environment over the long haul? Everybody looks like a genius when a market is moving up, or down, whatever the case may be, and they're in it, if you will. How do I say this? They're just lucky. They're in it for the ride because it appears that they're in it for the right reasons. But when they really don't have the hard data and understand what's going on, like I said, find me a handful of other analysts that understand that this is, or that will admit, maybe is a better way of saying it, that this is a bear market rally. They're not out there. They're not out there because they don't understand the environment. People will try to rationalize to say, well, okay, 140 years of data or whatever, volume really doesn't matter this time because. And it's like, well, this time is different because, and they rationalize this stuff away. No, the same rules apply. The same rules apply, and it is what it is. And, like I said, it's all about the setup, and then once that happens, I look for things to change profoundly. And, one thing that I think is different this time versus the 2007 top, and I'll venture out on this limb just a little bit, but in 2000 and 2007, it was just a stock market top. No big deal. But this time, I truly have some concerns, about and I think we're seeing some of that already, but I truly have concerns about the social implications, and the fallout from there. Some of the knee-jerk reactions, the political implications, and so forth. I really think this is a disaster that could come in from a number of aspects once things get underway.
Oh, I've been told by people in the know that the Baltimore riots have just as much to do with a bad economy as they did about being being upset by the actions of the police.
Well, sure. I agree with that. And that's what I'm saying. I mean, look at the job participation rate. Don't tell me that there's, whatever the numbers are, 5 or 6 or 7 or whatever the percent in unemployment is when I'm looking at the data. I mean, it's like trying to tell me that a milk cow is a billy goat. I mean, you can't blow that smoke up. I mean, just look, and just look at the data. And so you're absolutely right. I mean, there are no jobs. The economy sucks, and wait till this bubble pops. And that's what I'm saying. We're setting up for, I think, some serious problems. And I think that the powers that be obviously know that, if you think about it, because otherwise, why would they be doing what they're doing? I mean, and I'm not faulting them for doing that. Hell, if I was in their seat, I'd probably be doing the same thing, trying to jumpstart this thing. And so I'm not being critical in a bad way. I'm just calling it like it is. But I mean, what other option do they have, really, than to try to do the things they do? Because if and when it does come apart like that, I'm assuming they don't really want to see, a Baltimore situation in every major city in the U.S. because people are pissed off because they don't have a job and so on and so forth. So I think they are trying to save the market for good reason, but it's not working.
All that money they thought would be used to produce jobs again was used to buy back shares.
A lot of it has been used to buy back shares. Absolutely.
Tim, thanks a lot for chatting with us.
Jim, thank you. And I urge people, I know it sounds extreme, and I'm the first one to admit they've done a masterful job at keeping the wrapper on it, so to speak, and holding things together. But look, that has not changed a thing. And if anyone wants, I mean, please, people, it's not about selling a newsletter. I mean, it is and it isn't. We all want to, trying to make a living here. But what I'm saying is, the data is phenomenal. If you look at the data, it's available in the letter, and I don't know. I mean, that's my warning. Look at the data.
Check out Tim's website, Cycles News and Views, on cyclesman.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Check out our very popular YouTube channel, Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.